Bridget is going to talk to us about the other kind of exit. You know, we've heard all this exciting stuff about making all this money, but the reality is that as angel investors, inevitably, there'll be companies that don't exit in the glorious way. And so Bridget sits on a vast database of information about probably the biggest angel portfolio in New Zealand. And so I'll leave the floor to you to show us what you've got, and then we'll have a bit of a conversation, and I promise I'm not going to make any lawyer jokes.
Thank you, Deborah. I'm acutely aware that I stand between Robbie and his rosé, so I promise I will keep this as quick as I possibly can. Look, today we've talked a lot about what a successful exit means, and I think we should all be striving for positive liquidity, but we've also got to address sort of the other sort of exit, the harvesting of the rump. So in our portfolio, we would have an example of every one of these companies, except probably the lifestyle business company. And I imagine that every investor in the room has at least one company in their portfolio that fits into one of these categories. And if you don't, you should be up here telling us how to avoid having a company in the rump, because I think it's a very incredible skill set to have. Look, it's easy to start a company in New Zealand, and it's more difficult to liquidate a company. I think it's really important, if a company does start going or heading in the wrong direction, that as investors we start having those hard conversations early with the company, so everyone understands the position the company's in, what the options are, and how you're going to address them to try and avoid either a company in the rump or a written off company. All of these above examples of companies all take capital, they take capability, they take connections, and they take commitment. And when we look at our individual portfolios, what are we trying to achieve? We all know the numbers, 5 and 10 companies are going to fail outright. So it's getting rid of these companies as quickly as we possibly can, so it allows you as an investor to focus your connections and your capabilities on those companies that are potentially going to give you the success. You know, with every investment you make, and everybody knows this, you're not just investing capital, you're investing your connections, you're investing your network, you're investing your time. So it's making sure that you get to spend as much time with the good companies as you possibly can and getting rid of those failures. But often it's the companies that are going sideways or backwards that take up more of these, of the 4 Cs than they probably should do. So I've blatantly stolen this slide from Bill Payne with his permission, but I do think it's quite an interesting slide in terms of predicting success. And I ask you, when you look at your portfolio and the companies that you have, is there a correlation between the amount of due diligence that you have done on a company and the potential for their success? And I also ask, do you as investors, when you're looking to do a follow-on round, do you do a level of due diligence before you commit to following on in a company as if you were investing in the company for the first time, or leveraging somebody from an outside to provide some objectivity about whether or not this is a good company to follow on in? Every time you look at an opportunity, it's a great time to apply scrutiny to that company and see if there are any red flags around the management, around the technology or the product that might mean that you should walk away. Some of you would have already seen the Rob Willbank study. This is his presentation from the Tracking Angels Returns 2016 study. The numbers were calculated using actual fully exited companies. There were 246 companies in his data set. The key point here is only 10% of all exits returned 85% of all the cash. So how does New Zealand compare? We only had 26 companies. I wanted it to be directly comparable, so we've only used companies that have been completely written off and are no longer in existence or have been exited. So there's no living dead companies in this, and we're currently only returning 80 cents in the dollar. We made our first investment in late 2006. We've gone on to invest into 157 companies, investing 46 million across 428 rounds, but it's still quite early days for us. So, the 80 cents in the dollar is it needs to be put into context. We have written off completely 29 companies. That's either book value or completely written off, but we're still pretty optimistic about what our portfolio can go on to achieve. And we've only had one IPO. To somebody who said the IPO took 9 years, we've had one IPO. It's an 8-year hold to date for us. So looking at the average investment history of SCIF, this shows that the average size of follow-on rounds that we've participated in, and possibly by looking at this slide you could infer that maybe not enough capital is being raised in rounds 2, 3, 4 or 5. And often companies don't have enough growth when they go to do a next round of capital, and that's when dilution can occur, and the negative impacts that can have. Nelson Gray, when he was out here last year, commented on the size of our rounds and suggested that they were too small. And the Startup Magazine, or the Young Company Finance report that we've just released, showed on average that our rounds are $498,000 on average. Compared to Link Scotland over a similar period, their average round size is 1.1 million. The Halo report of 2015, their average round size is 1.5 million. And the latest data out of the UK Co-Investment Fund puts their average round size at around $4 million. So I asked the question, has the amount, or has how we follow on or how we allocate capital across investment rounds impacted on the likely success of some of our companies? Is it a case of not funding companies enough, or not funding the good companies enough in order to let them achieve some success? So I've compared our portfolio in two ways. So the first way is on a valuation process. We've just finished our valuation, so these numbers are for 30 June 2016. What it shows is the top 40 companies are going to return 76% of potential value based on a book value basis. That means 110 companies in our portfolio are valued at $13 million in total. That's less than what our top 5 companies are currently valued at. These numbers are purely on a valuation basis, but they're still taking up a huge amount of time, of resource, of commitment, and it's a big issue. We've got a big rump of companies, that are still liabilities for us. So I did a different comparison, and this is a piece of work we do in conjunction with all our partners, and it's forecasting potential EV of companies further down the track. And we review this twice a year, and as everybody knows, in the world of startup, things can change really quickly, so this is a best guess at the time of based on the information that we have. But what this is saying is one company is going to give us 11% of our returns likely, and 20% of our companies are going to give 83% of the returns. So it doesn't matter which way we kind of cut our portfolio. It seems that either on a book value basis or on a forecasted EV basis, the same numbers, a small number of our companies are going to give us the biggest returns. So what I wanted to do was look at the top performing companies and the bottom performing companies and see if they actually are using up all the same capability, connections, commitments, etc. So the top 20 companies, we have gone on to raise 64.3 million in total. And the bottom 20 companies have raised 30.5 million. So it's quite positive. The poor performing companies have only raised half as much, average round sizes of 3.2 to 1.5. So I thought that was a really positive thing. So I thought I'd look at the only way I could look at sort of the commitment side of it, and that is looking at number of shareholders and number of directors. So the top 20 companies on average have 4.3 directors per company, and the bottom 20 have 3.6 directors on average. Top 20 companies have 21 shareholders on average. The bottom 20 companies have 15 shareholders on average. And what I think the message on, or what I was trying to achieve with that, is just show that actually these poor performing companies are taking 3.6 directors every time that we could actually put into the better performing companies if we liquidated these quicker or managed to exit them in some way. But you can't just ignore them. They are there. Just a quick note, so our quickest failure was 90,000 and the company was wound up in just under a year. Our slowest failure was 450,000 and it took just over 8 years for that company to be wound up. I don't have anywhere near the answers for this, and I think everybody in the room probably can add a huge amount more to this than me, but a couple of thoughts I had about this was avoiding red flags that will put buyers off. If there are no potential buyers out there, what are you doing it for? You need to build an exit-ready company from day one, and an exit-ready company and a liquidation-ready company is the same thing. It's just at different ends of the spectrum with different potential outcomes. But you need to be ready, have accounts in order, all those sorts of things. A lot of what gets talked about is the capital that gets invested into these companies, and I think you also need to say time and experience is just as valuable. And sometimes I wonder if part of the reason a company ends up in the rump is the investors that invest in those companies don't have the time to be able to spend mentoring or providing the guidance for those companies. Some key areas that might be an opportunity as an investor to influence where the company's going. It's unlikely that the founder is the right person to take a company from zero to exit. So it's something that should become a formal board item that you discuss, twice a year. And don't assume that the founder will be resistant to that, because sometimes they understand that it is the best thing, but it's about having that conversation early. I think it also comes to the same thing with the board. Again, Nelson, when I was talking to him about this, he said, a non-exec director is not there. It's not a job for life. They're there to impart their wisdom and their knowledge on to the management. And 2, 3, 4 years down the track, they should have done that and should be looking to move on. So as investors, it's an opportunity for us to challenge if where the company's at the moment has the right people sitting around the board table in order to help them achieve what it is they're trying to achieve. Again, what are you trying to do it for? Who are your potential acquirers? Focus on what is the growth that you're trying to achieve. We focus quite a lot on turnover or profit, but is that actually what acquirers are looking for, and is it just actually a case of wasting capital if that's what the focus is? Alignment between investors. When we all commit into a company in the first round, it's understanding how long it's going to take to get a company to where it's going to go, how many rounds of investment, the commitments you're going to make, and understanding who's on the same page, and making sure that if investors are only there for the first round, that you understand that right from the start. And leverage the angel community. There's, the huge amount of experience in this room, and there's huge opportunities if you've got a company that's trying to achieve X. I'm sure there's somebody in the room that has probably done that, experienced that can provide help and guidance for you on that one. And then also share the learnings, destigmatise having these companies that sit in the rump. It's a really great opportunity for us to share what we learnt and how to try and avoid doing the same thing twice. It's got an interesting, one of our companies we had written it off completely, so it hadn't exited, but we had a book value of 0. A couple of years ago they brought on a new investor who had significant expertise in the sector in which the company was focused on, and that person took a seat on the board, and just in the 30 June valuation we've revalued that company back up at cost. The trajectory of that company has significantly changed. Now, it may go on to be very successful, it may not, but bringing on somebody with new and renewed focus has completely changed the trajectory for this company at the moment. This slide comes back to my earlier point around DD, and it's a slide that earlier, or in the middle of the year, a whole bunch of us met and talked about this issue, and we came up with sort of this gating tool, and it's just a starting point, I guess, for some of the headline topics that you might want to consider when you're looking at an investment. And it doesn't matter what sort of systematic numbers you use. You can use a scale of 1 to 10, you can use negatives and positives. As long as you know what a 1 and a 10 means, it will at least, if you apply that scorecard to something like this, tailored to your needs, it will at least help you highlight or identify the areas of focus where you might need to do more digging to make sure that these aren't issues where you should potentially walk away. You need to be as objective as possible and don't just put money into the company just to keep it afloat, which we quite often can do. And as it's been said before, the most difficult aspect of managing your portfolio is knowing when to walk away. When it's time to move on. As angel investors, we can have a tendency to invest just one more time in the hope or the belief that we might have the experience or the ability to be able to change the direction of the company. So it's working out, how much you can invest and still have the ability to walk away if that's the best option for you. I was going to spend some time talking about this, and then I realised that actually there are 3 experts sitting along there that have a lot more experience in this than me, so I'm actually going to stop and hand it over to Deborah and the 3 experts.
It occurs to me that the rump is what you see in hindsight. Promise no lawyer jokes. Bruno, perhaps I'm going to talk to each of the 3 panellists, particularly about that idea of, okay, so you've decided this company needs to die. How do you go about doing that? What are kind of the top 3 or 5 things that you need to have really top of mind when you decide, okay, we're killing this?
So I'd drop it into sort of 3 categories. First is doing the stock take, understanding exactly what the company has and what runway you've got and what plan to play with. You've got to play with as part of the equation. Going through what your contingent liabilities are, what your fixed liabilities are. People treat everything with rent, but look at some of your hosting arrangements and all those sorts of things. Get a general snapshot, work out how much time you actually have got to work out a solution, and then look at what types of solutions. So move from the stock take sort of scenario into then what options have I got available to me as part of the equation. And they will take time to fixate them themselves if you're looking to try and push it on to somebody else or merge or roll up with another company. You're going to need time to have those sort of conversations. So the reality is, in a perfect world, you want to have at least 6 months runway to do it. The reality is 3 months, most people go around a mad scramble. First thing to do as part of the stock take as well is apply the brakes as part of the equation, dial back all the expenditure, bring it back down to the minimum team. The minimum team that you can actually still stitch together whatever deal you might want to do, but a minimum team that's not going to run you into the wall and create an absolute train wreck as part of the equation. And those sell-down options may range from finding a strategic buyer to rolling up. We've had 2 angel investment companies that got rolled up into another company. So as a service company, it could actually wrap a bit more structure around the sales cycle as part of the equation, as part of it, handing back to the entrepreneur. Sometimes the entrepreneur wants to continue to roll on. That's fine, they might want to make that call. Quite often the deal gets cut around retaining a percentage of ownership or whatever it may be. My general thinking on that is, rather than a percentage of ownership, you sell the assets to a new company and you take a percentage of any sort of profits or revenue from that new company, rather than taking a percentage taking that new company and still living through a torturous sort of lifestyle, maybe a 10% stake in the company, which even gets diluted over time. And as a reminder, the reality is most ones and deals we've done of that nature, nothing's ever spun back around. The entrepreneur has the energy to sort of push it on and go for a bit further, but then they actually run out of steam themselves as part of the equation. And then I move to the stage of killing it, and so from there it's really either looking at, if it is still solvent, you can look at a removal from the register, which is a relatively inexpensive process. As long as you can get a letter from the IRD saying you're up to date with the taxes as part of the equation, you can get any assets that are left out of the company on a generally tax efficient basis, and it's cost effective. If you need to switch to a liquidator, provision 5 to 10 grand as part of it. Try and find something that's practical, that knows how the real world works and knows that you gave it your best shot, and is not there trying to get a scalp and trying to line you off the liability as part of the equation. From there, and you used to be able to rely on the good old company's office to strike you off if you sort of failed to do your annual returns. Now they're just buying you and turning them into revenue generation schemes, so that one's taken.
Excellent, thank you. Gavin, KPMG perspective on how we deal with these companies that probably were insolvent long before we started dealing with someone said earlier, we're managing insolvent companies.
Yeah, so I think, many of my points probably reflect Bruno's. From our perspective, it's, I guess time's a critical issue. So, as investors, as people that might be involved in governance of these businesses, this needs to be something that's managed on a regular basis, that these events will happen. So the more time you can give yourself, the better the outcome in our experience. The more you can stay in control of the process, the better. So many of the situations we find that end up in a complete train wreck where the founder or the governance wrapped around them just haven't had visibility over particular cash flow issues, particularly around the IRD and things like that. So you get the IRD coming in and putting pressure on wind-ups. I think the main issue that I think we see on an ongoing basis is lack of clarity around objectivity about the future of the business. So, are you getting a regular third-party sort of opinion about the financial state of the business, and particularly the cash required to carry on the business over a particular period of time? And I also think that where we're seeing the cash flow management is a particular weakness of most New Zealand businesses, but particularly in this space, unrealistic rolling cash flow forecasts. I know that it's never a science; it's more of an art. But where we see that done well, it gives the team a little bit more runway where they face these sort of exit issues.
Thank you. I'm going to move on to Mark from AJPark, and I guess from my perspective, the IP questions are really interesting here as well. My most bruising angel experience so far, I'm sure there'll be more, was sitting down with a founder and saying to them, unless you agree with the board's decision to appoint a new CEO, we're going to close down the company and sell the IP. So I'm interested in your views about how that might work and whether that's actually a solution or not. Because it didn't work for me. The founder agreed, and then 6 months later the new board had reappointed them.
Yeah, I think the founders often have a slightly different view of IP valuation than others. Yeah, I mean, a good IP doesn't necessarily guarantee a good business. So you can have a business that fails but still have good IP sitting in it. The key issue is how you value it. It's not easy. It's an art. It's not a science. It's probably a dark art. And really the key is finding the person in whose hands that IP is going to have the most value. And so that means, for example, if you've got a patent portfolio, do you have a competitor that finds that patent portfolio as a key freedom to operate risk? Would they pay quite a lot to take ownership of that and therefore clear that risk? And the other thing to think about is, what are you actually selling? Are you just selling pure IP, or are you selling the technology underneath it? Because more often than not, you're selling both. So do some searching, check databases to find out what competitors are doing, who's working in your technology space, and who might actually have a use for this. That's a key thing. And then you either have a bilateral negotiation with them, or you look at IP marketplaces. There's patent marketplaces in the US. They're a little bit subdued at the moment. The valuations are pretty low compared to where they were, and you need a fairly, groundbreaking patent to make a lot of headway over there. Sale of patents is taxable as income in New Zealand, so tax is always relevant when you're trying to sell this stuff. Do your vendor DD? Surprising how many businesses are trying to sell stuff they don't own. So the IP is still sitting in a holding company, it's still sitting in the founder's name, the staff haven't assigned it across or whatever. Know-how is really interesting. We had a client who was approached by a US company offering at $5 million US to buy its manufacturing know-how, and they thought, brilliant, that's fantastic, but it turned out obviously that the US company anticipated that we would never use that again for our own business. So there was a complete mismatch as to what sale meant. Other options, you could license, but do you want to keep a company going that's just getting royalties? You could transfer it to a holding company, but you still have to pay maintenance, etc. You could open source it. You know, Elon Musk open sourced all the Tesla patents recently. I don't think it was because that business was going out of business, but you know, you can put your IP out there to try and encourage development around it. And I guess the only other thing I'd say is if you don't do anything and it does wind up, then the assets revert to the Crown, who may well be the biggest IP owner in the country. We don't know.
I guess what I'm interested in is NZVIF's position. You know, obviously going into these companies, you do it on a passive basis, following the angels. Do you take the view that the other side of the equation, you should be equally passive, or is this something that, you know, given the size of the portfolio you're sitting on, you see VIF potentially taking a more active role in kind of killing off some of the rump?
I don't want to think that we would be getting too active. I'd like to say that we're a passive investor and active shareholder, so I guess in that concept we should be being a little bit more active. But I mean, you know, going back to my point, we've got 110 companies that are valued at 13 million or less. That's huge, and for us, even getting a little bit back or having that those companies no longer sort of liability companies for us is hugely important. So I guess it would be NZVIF would help out in helping our investors that we've co-invested alongside to get rid of some of those companies.
I'm interested in your guys' view on what, I mean, for me, for an individual angel, just ignoring the companies and the rump are fine. But once you've got a portfolio that size, what's the danger?
Well, it's not so much danger, it's just being aware more than anything else. You know, the reality is, you know, and I've gone through 3 of the other exits with NZVIF, and they've been fine on every instance because we've kept them informed. Everyone, and even the angels, you get the anger, you get the sort of remorse, and then you sort of get resignation towards it, and you move through the process, and you get there eventually. But you know, like anything else, it's just another shareholder decision. So you need to actually bring the people along, explain why you're doing it, explain the rationale, explain what you've been up to and what you've looked at. And you know, certainly from what I've seen from NZVIF, and that was, you know, 3 different types of scenarios as well. And they went, yep, we're across it. We're not going to stand in the way of it. It makes sense.
Yeah, and I think you know, having a sense of understanding that all the stakeholders understand what the exit opportunity or the exit options are, and some of the you know, positives and negatives. You know, if you leave it too long and you're in that insolvent wind-up sort of situation, it can be pretty nasty and cost all parties. So I think as long as everyone understands what all those options are and you can make a considered decision, it's a lot more positive process.
It's not really helpful if the directors all run for the hills, though, is it? You need someone there to close the doors.
Which is what we find often, the sort of living debt is the very difficult part of it. We've had some that have just gone because nobody's taken an active role in taking that last step of execution and treating the company. And so it gets very hard and very difficult to find people who want to step up and put in their work to drive it over the line.
Sure. Do we have any questions?
That sort of leads into a question. So what would you take for that? For those 100 companies, would you take 10 cents in a dollar?
Just put me on the spot here. Yeah.
Just whip around a hat.
Yeah.
So what's the opportunity cost? It's probably, you know, tens of millions of dollars across all the investors in their portfolio of businesses. So if we said we're going to sell those 100 companies for $2 million, you know, so that's 20 cents, you know, 15 cents in a dollar. So get in line, guys. Because we believe that we could do something with perhaps half a dozen of those companies that would double that investment because of the reach we had and the capability and the focus we could apply to it. And it would liberate, you know, a pile of folk, you know, a pile of capital to focus on those ones that are, you know, really progressing. So I think that's probably another approach that Viv and the rest of our sort of NZ mindset needs to take. So we've got to liberate. We've got to clear our heads. There's a massive opportunity cost. Across that 100 companies, we'll take 15 cents in a dollar. Let's find someone to take the whole lot.
I think we'd be very supportive of that position for exactly the points you said. It'd be nice if it was 20 or 25, but it's a big number of companies, and if we could free up some of those entrepreneurs and the investors that invested in those companies to go on and do other things, then it's all for the good.